2-week low for 3M today as well. Thank you, Renita. Thanks. Now let's take a look at the bigger picture. Anthony Saccaro is with us, president of Providence Financial and Insurance Services, also the author of More Life Than Money, How Not to Outlive Your Savings, coming out on February 7th on Amazon and Barnes & Noble. Congratulations to you on that book. It's great to see you. How are you feeling overall when you see 2023 here? What are you telling folks?
You know, there's a lot of conflicting information out there, right? We've got inflation that's still high, although it's starting to soften, which is good news. We've got unemployment numbers that are coming down, which is the opposite of what you want to see happen. So the market has been fairly resilient so far in 2023. I think that the worst is yet to come, though. I think the Federal Reserve is holding off a little bit. All the consensus is that they're going to raise by 25 bips in this next meeting next week, which I think is what they should do. Slow down a little bit, take the foot off the gas, let the inflation numbers kind of catch up. That's a lagging indicator. But I think that ultimately, as the unemployment numbers start to grow, which they have to, it could cause a shock to the stock market. And I think 23, if you're going to back me in the corner, is probably going to be a worse year than it is going to be a better year. I think we got a lot of rough waters ahead.
Tell me more. Explain what that means.
Yeah, so the bottom line is that inflation has to come down. But in order for inflation to come down, the unemployment numbers have to go up. And right now, unemployment's at 3.5%. The last couple of months, it's ticked down a little bit. But there's a lot of professionals that are thinking it has to get in the 4 to 6% range. I think it's got to be above 5%, that unemployment number. So when you get an unemployment that's in the 5 to 6% range, those people are not going to have jobs. Savings, all-time savings are coming down now. Credit cards spending are going up at this point. And so when you add a higher unemployment rate, there's going to be a shock to the system where all of a sudden the market wakes up one day and says, oh, my gosh, we got a lot of people unemployed, and we have no more savings anymore, credit cards through the roof. We can't handle this. Oh, by the way, with all these unemployed people, corporate profits and revenues are going to be coming down, so earnings reports are going to get weak. And I think all of that hitting at one time could cause a financial shock, and we could have some major problems ahead later this year or maybe even next year. And, of course, the recession is on.
Yeah, so it's like it's going to get worse before it gets better. That being said, what's your advice to folks so they don't run out of money?
So I think what you need to do is certainly depends on the phase of life you're in. If you're heading towards retirement, you keep doing what you're doing. Stay invested in stocks or your growth-based mutual funds or even your value-based mutual funds. If you're in retirement, it may not be a bad time to shore up your portfolio and focus on income. Income is the one thing you can count on, and that's regardless of whether you're saving for retirement or whether you're in the retirement phase. Focus on dividends. I think the next decade, which a number of professionals have said is going to be flat in the market, maybe even slightly negative, I think it could be known as the decade of the dividends because that is what you can count on. Your income in your portfolio is what you can count on. You can't count on your share price, but you can count on the income if you have an income diversified portfolio.
I see. So when you look at how we can generate some revenue and make a little money, how do you recommend people do that?
So there's a number of ways. First of all, most advisors, I think, are mostly accumulation type strategists. So if you're going to be looking at mutual funds, you're going to have a hard time getting a higher net yield on mutual funds because of the internal fees and so on. But there's a whole universe of options out there, including things like REITs and preferred stocks and BDCs, and for older people, maybe even annuities that could offer you 4 or 5% with hardly any risk. There's a lot of options out there that will allow you to get interest and dividends from your portfolio while protecting your shares. And it's all about the shares. The share price is going to fluctuate. But as long as your interest and dividends is the same, then you've got something to reinvest. You don't need to spend them. And if you do need to spend them, then that's fine because interest and dividends are renewable resources. You can spend them and count on them again next year as long as you've got a quality, diversified portfolio. So spend the interest and dividends. Don't sell shares to get your income if you're a little bit older.
I see. And when you were putting the book together, was it easy to sort of narrow down the topic?
You know, I had to limit it to the topics I felt were the most important. I've been a financial advisor specializing in retirement for 23 years. And I've learned that it's not what you know that's going to hurt you. It's what you don't know that's going to wreck your retirement. And in the book, there are 10 different chapters about things you don't know that can absolutely wreck your retirement. And that's why I put the book together. I'm an educator at heart. I just want to make sure that my clients don't run out of money before they run out of life. And the challenge is, I think there's a whole wave of baby boomers that are going to get out into their 80s that have been cannibalizing their principal and manufacturing income and don't realize it, and their portfolios are going to be cut. The next 10 years is not going to look like the last 10 years. The last 10 years, people have gotten away with it. The next 10 years, they may not be so lucky.
Well, I mean, we really were in the midst of a bull market. I mean, there were some people who thought it was a secular bull market, and we were just sort of taking a pause.
Yeah, absolutely. And that's what Wall Street really wants you to believe, is that it's just going to go on forever. And that's what we want to believe too, right? I don't want to believe that there's going to be a negative bear market. But history tells us that there are good periods followed by bad periods. And when I say period, I'm talking 10 or 15 years. There are good 10, 15-year periods where the market goes up double digits. And then there are bad 10 or 15-year periods where the market is just flat. And when I say flat, I don't mean like flat line. I mean ups and downs and bears and bulls that are more cyclical, but wash each other out. So at the end of 15 or even 20 years, there's just no growth in the market. This is the way history has been for over 200 years of Wall Street. So we should expect it. And when you look at the fact that the first 13 years of this century was flat, and then the last 13 years it's been double digits, it's no doubt that history is telling us clearly that the next 10 or 15 years is probably going to be more on the flat side. It just follows the trends of history.
Yeah, Anthony Saccaro, great to see you. Thank you so much. Providence Financial and Insurance Services and author of More Life Than Money, How Not to Outlive Your Savings. Thanks. Still to come right here on the watch list, we'll discuss the outlook for Tesla with the team from ARK Invest. What could autonomous driving really mean for the stock's price? Plus, we'll discuss why companies need to evolve over time or risk going out.